Ever found yourself pondering why being less fortunate can actually cost you more? This question is not a mere philosophical musing, but a stark reality for many. It's a phenomenon referred to as the money paradox. You may be wondering, what is this paradox all about? It's the counterintuitive concept that those who have less often end up spending more, and we're not just talking about percentages, but actual hard cash. Let's break this down. Imagine two individuals, one with a comfortable income and another barely making ends meet. The first individual can take advantage of sales, buying in bulk to save money in the long run. They can invest in quality items that last longer, offering better value over time. They can afford preventative health care, reducing the risk of costly medical emergencies. They can also access better financial products, such as low-interest loans and premium bank accounts. On the other hand, the less fortunate individual is often trapped in a cycle of buying only what they can afford at the moment, which is often smaller quantities of lower quality goods. They might skip regular health checkups to save money, risking serious health issues down the line. They also often fall prey to predatory lending practices, ending up with higher interest rates and more debt. This is the money paradox in action. The money paradox is not a rare phenomenon. It's a reality that silently shapes the lives of many around the world, creating a vicious cycle that's hard to break. However, understanding this concept is the first step towards addressing it. By acknowledging the existence of the money paradox, we can start to question our own assumptions about money and poverty, and begin to think about ways in which we can help to break this cycle. Stay with us as we delve deeper into the money paradox and discover how it affects everyday life. We'll be peeling back the layers of this complex issue, exploring its various facets and impacts, and hopefully shedding some light on how we can begin to change this narrative. So buckle up and prepare for an enlightening journey into the world of the money paradox. To kick things off, let's examine how poverty can lead to higher costs. Think about it, doesn't it seem counterintuitive? Those with less money end up paying more. But the harsh reality is that poverty can indeed be expensive. Firstly, consider the realm of finance. Financial institutions often view the impoverished as riskier clients. This perception can lead to higher interest rates for loans and credit cards. So, those with the least end up paying the most for the privilege of borrowing. A stark representation of the money paradox, wouldn't you say? Then there's the issue of late fees. When you're living paycheck to paycheck, it can be challenging to keep up with the barrage of bills. Every delay, every missed deadline incurs a late fee. And these fees, they pile up, digging a deeper hole of debt for those already struggling to stay afloat. Now let's talk about economies of scale. Buying in bulk often leads to savings. But when every penny counts, it's hard to justify spending more up front, even if it means saving more in the long run. So the impoverished often buy smaller quantities at a higher unit price. Another way poverty costs more. And then there's the cost of time. When you're poor, time becomes a scarce commodity. Time spent working multiple jobs, time spent commuting on public transport because owning a car is a luxury, time spent queuing at discount stores. All this time spent just surviving. It's time not spent on education, self-improvement, or pursuing opportunities. And that's a cost that's hard to quantify. Now you might be thinking, how is this possible? Let's dissect this further. Ever heard of the term poverty premium? Let's see what it entails. As perplexing as it may sound, the poverty premium is a phenomenon where those with less money often end up paying more for the same goods and services. It's a formidable economic paradox that adds an extra burden to those already struggling financially. Imagine this. You're at the supermarket and you've got two options for laundry detergent. One is a larger pack, offering better value per wash. The other is a smaller pack, cheaper up front but more expensive per wash. If you're living paycheck to paycheck, the smaller pack might be the only feasible option, even though it's less cost-effective in the long run. That's a simple example of the poverty premium at work. But it's not just about bulk buying, it extends to services too. Without access to mainstream banking, some low-income individuals resort to using alternative financial services like payday lenders. These lenders often charge exorbitant interest rates, making the cost of borrowing money much higher for the poor than for the affluent. Utilities are another area where the poverty premium rears its ugly head. Prepayment meters for gas and electricity, often used by low-income households, can be more expensive than direct debit tariffs. So even though they're using the same amount of energy, those less well-off may end up paying more. Similarly, those with lower credit scores are often subjected to higher interest rates on loans and credit cards. This means that borrowing the same amount of money can cost a low-income individual significantly more than someone with a robust financial profile. In essence, the poverty premium is a harsh reality for those struggling financially. It's a system that, rather paradoxically, makes the cost of living more expensive for those who can least afford it. It's a cycle that feeds on itself, perpetuating the financial struggles of the less fortunate. The poverty premium isn't just an economic term. It's a societal issue that needs addressing. In essence, the poverty premium is a harsh reality for those struggling financially. Debt is a vicious cycle, but why is it more ruthless for the less fortunate? Let's delve into the concept of the cycle of debt, a phenomenon that is particularly prevalent and damaging among those with less financial means. Imagine this: you're short on cash, and an unexpected expense arises. You need to fix your car or pay a medical bill, and you simply don't have the funds. So what do? You might turn to a payday loan, a type of short-term borrowing where a lender extends high-interest credit based on your income. It sounds like a quick fix, right? You get the money you need and you plan to pay it back with your next paycheck. But here's where the cycle begins. The interest rates on payday loans are often sky-high, sometimes reaching up to 400%. This means that by the time your next paycheck comes in, a significant portion of it goes towards paying off the loan, leaving you with less money to cover your regular expenses. So you may find yourself short on cash once again, leading you to take out another payday loan, and the cycle continues. High-interest credit cards can also contribute to this cycle. If you're using a credit card to cover basic expenses because you don't have enough cash, you're likely to incur high interest if you're unable to pay off the balance in full each month. Over time, the interest charges accumulate, and you end up owing more than you initially spent. What's more, late fees and penalties can add up quickly, making it even harder to pay down the debt. Before you know it, you're stuck in a loop of borrowing, spending, and owing, with each round leaving you deeper in debt. This is the cycle of debt. It's a trap that's easy to fall into, especially when you're already struggling financially. And once you're caught in it, it's hard to break free. It's like trying to climb a mountain that's constantly growing taller. The cycle of debt is a trap that's hard to escape, especially for those already financially strained. Health is wealth, they say, but what happens when you lack the latter? The link between financial stress and health is well documented. When your mind is constantly occupied with worries about rent, bills, and putting food on the table, it can take a severe toll on your mental health. Anxiety, depression, and sleep disorders are common among those struggling to make ends meet. And these are not just abstract concepts. They're real, tangible issues that affect people's lives every day. But the impact doesn't stop at mental health. Chronic financial stress can also lead to physical health problems. High blood pressure, heart disease, diabetes, and a weakened immune system are all possible side effects of prolonged financial stress. The body's response to stress is a complex one, and over time, these physiological changes can result in serious health complications. What's more, those with limited financial resources often can't afford preventative health care. Regular checkups, healthy food, gym memberships, these are luxuries for those living paycheck to paycheck. When you can't afford preventative care, you're more likely to end up with serious health problems that are not only painful and life-altering, but also incredibly expensive to treat. This creates a vicious cycle, where financial stress leads to health issues, which in turn lead to more financial stress. It's a cycle that's difficult to break, and it's one that millions of people around the world are trapped in. And yet, despite all this, it's important to remember that there's more to health than just physical well-being. Mental and emotional health are just as important, if not more so. The stress of living in poverty can lead to feelings of helplessness, despair, and isolation. It can strain relationships, shatter self-esteem, and rob people of their hope for a better future. Indeed, the cost of being poor isn't just monetary, it's a matter of health too. The money paradox isn't just about dollars and cents, it's about the very real, very human cost of poverty. It's about the toll that financial stress takes on our bodies, our minds, and our spirits. It's about the price we pay in health and happiness for the simple act of trying to survive. Education is seen as the key to success, but can it also be a financial burden? We often hear that education is the passport to a promising future. It's presented as the solution to escaping poverty, the ticket to higher-paying jobs, and the route to a better life. But what if this very tool of liberation could also be a shackle of financial burden? Education, particularly higher education, comes with a hefty price tag. From tuition fees to textbooks, accommodation to sustenance, the costs can quickly escalate. And for those from low-income families, these expenses can be daunting, often resulting in the need for loans to cover the costs. In many cases, these loans come with high interest rates and long repayment terms. So while the graduate may have their degree in hand, they also hold a lifetime of debt. This debt can impact their ability to save, invest, or even start a family. It's a bit of a paradox, isn't it? The very thing that's supposed to bring financial stability can also lead to financial instability. But it's not just about the financial cost. There's an emotional cost too. The stress and anxiety of being in debt can impact mental health, leading to a cycle of stress, poor performance, and even more debt. It's a vicious cycle that can be tough to break. And what about those who can't afford the cost of education at all? Do they miss out on the opportunities that education provides? Does the lack of money cost them more in the long run? It's a complex issue with no easy answers. So, while education is undoubtedly vital, it's also important to recognize the financial burden it can place on individuals, particularly those from low-income families. It's a paradox that needs to be addressed if we want to truly level the playing field and provide equal opportunities for all. Education, while crucial, can also contribute to the money paradox. So we've seen the problem, but what about solutions? Can the cycle be broken? The cycle of poverty, as daunting as it appears, is not an inescapable trap. With the right strategies and policies, it is possible to break free from this vicious cycle. Let's start with financial education. Knowledge, they say, is power, and in the context of poverty, this couldn't be more true. By teaching people the fundamentals of finance, how to budget, how to save, how to invest, we equip them with the tools to make informed decisions about their money. This knowledge can be the key to unlocking a future free from the constraints of poverty. Take affordable housing as another example. The cost of housing is often a significant burden for those living in poverty. By providing affordable housing options, we can help to alleviate this burden. Not only does this provide a stable environment for families, but it also frees up income that can be used for other essentials or invested in future opportunities. Then there's the topic of wages. An increase in minimum wages can provide a significant boost to those on the lowest incomes. This isn't about handouts, but about ensuring that everyone is paid a fair wage for their work. This can help to bridge the gap between the rich and the poor and break the cycle of poverty. But it's not just about these individual strategies. It's about creating a system that supports people in their efforts to break free from poverty. This requires a collective effort from all of us, from policymakers to businesses, to each one of us as individuals. It requires policies that are grounded in fairness and equality, that provide opportunities for everyone, regardless of their current economic status. Breaking the cycle is possible, but it requires collective effort and sound policies. Let's all work together to make this a reality. In wrapping up our exploration of the money paradox, let's take a moment to revisit the key insights we've unearthed. The money paradox, as we've discovered, is a cruel irony where the less money you have, the more expensive life becomes. This is a reality for millions worldwide, a bitter pill that makes breaking free from the cycle of poverty an uphill battle. We delved into the cost of poverty, where we learned that those struggling financially often face higher costs for basics like food, utilities, and financial services. This is referred to as the poverty premium, a term that encapsulates the additional costs shouldered by those in low-income brackets. We then navigated the treacherous cycle of debt, a whirlwind that spins individuals and families into deeper financial hardship. The cycle of debt is a relentless vortex, ensnaring those who can least afford it and making it nigh impossible to escape. Our exploration led us to the impact of poverty on health. The stress of financial struggle takes a toll not just on the wallet, but on the physical and mental well-being of individuals. It's a burden that weighs heavy, affecting every facet of life. We also touched on the education paradox, where those who can't afford quality education for their children often find themselves trapped in a cycle where the lack of education perpetuates poverty. Finally, we discussed breaking the cycle, underlining the importance of collective efforts in addressing this complex issue. From policy changes to financial literacy, there are myriad ways we can chip away at the money paradox. Understanding the money paradox is crucial in addressing it effectively. It's not just about recognizing the problem, but about fostering empathy, sparking conversations, and driving change. It's about making the invisible visible and bringing to light the struggles that often go unnoticed. Remember, understanding the problem is the first step towards making a difference. Stay informed, stay empowered.